Do you want to know the worst financial mistake a doctor can make? Keep listening to hear Bill Bernstein and what he thinks about that. Bill, welcome to Money Meets Medicine.
Happy to be here.
Yeah, happy to have you. I've really been looking forward to this and have wanted to have this conversation, to be honest with you, for a long time. And big fan of your work, The Four Pillars of Investing, the Investor's Manifesto, if you can. And, as a bit of a background, I reference that to all of my fourth-year medical students. I teach a fourth-year medical student curriculum at Wake, and I reference the If You Can PDF every single year. So really, really appreciate the work that you do. So I thought we would just jump right into this. So you are a couple of times different writings. So if you can, you basically say that we should be wary of the financial industry. We should consider them hardened criminals. And I think in the Four Pillars of Investing, you mentioned the financial industry being a bit of a battlefield. So you were a neurologist, physician, and then you transitioned yourself into the financial industry. So I'd love to know your take on joining the fray of the financial industry and potentially why doctors should be wary of trusting folks in the industry too.
Well, people don't go into finance for the same reason that they become diplomats or elementary school teachers. They go into finance because they are really focused on making money. And there is an inverse correlation in finance between how ethical you are and how much money you make. I heard a podcast the other day in which the father of a very famous pop star said that he was in the top 1% of stockbrokers. And I'm thinking, right, what does that tell you by the way about the way he treats clients? It means he's making an awful lot of money, and he's making an awful lot of money from his client. And so that's the problem that people in finance have. And I occasionally get, asked by undergraduates in economics and finance, how do I get into the business and what should I be thinking about? And that's the first thing I tell them is there's an inverse correlation between how ethical you are and how much money you're going to make. And if you're on the other side of that equation, if you're hiring a finance professional, you have to understand that the average financial professional services his clients in the same way that Babyface Nelson serviced bank.
So in that situation, do you encourage them to be less ethical so they make more money, or do you encourage them to reconsider things in terms of how much money they expect to make?
I think it's fairly self-explanatory that if you want to be able to look in yourself in the mirror in the morning, that's going to have a price. And that, of course, is something you want to be able to do. You do want to be able to look at yourself in the mirror. The money is secondary.
So explain to me the transition then for you from medicine, working as a neurologist, to creating your own financial advisory firm. What led you to make that transition?
Well, I happen to live in a country that doesn't have a functioning social welfare system. So I realized I was going to have to save and invest for my own retirement. And I'm trained as a scientist. Not only have a medical degree, but I also have a degree in physical science. And so I approached the problem the way that I thought that any scientist would do, which is I read the peer-reviewed literature, I collected data, I built models. And this is, you have to understand, back in the early 90s, when that sort of thing was not so readily available. And so I collected my models and my data and I wrote it up. And I realized I'd done something that was useful not only to small investors, but it turns out to professional investors as well. And I started a website, again, back before blogging was called blogging. This was, again, in the mid 90s. And I started getting calls from financial journalists who were looking for stories. And then I started writing books. And once you start writing books and getting, quoted in the Wall Street Journal, people ask you to manage money. And so that's how that happened. And then something happened after that was even more interesting, which is if you're going to write about finance or do finance, and we'll get to this a little later in the podcast, you have to know something about financial history. And I found that I enjoyed writing about history in general. So I sort of made a third career out of that as well.
Yeah, I think that's actually a really interesting thing to point out, that for whatever reason, when you write a book, you've become now an expert in said field, and people tend to trust you more, and that's an interesting thing. But you made a transition from, let's say, your undergraduate work to medicine to the financial industry, and then you have had multiple pivots during your journey. So For the doctors who listen to the show that maybe they're in training or maybe they're in the first 5 to 10 years in practice, I think that I didn't anticipate having the pivot that I had. I'm curious to know if you did. And if you could go back to your days in training, would you have wanted to know that you're going to take that turn in your career, or did you kind of find it helpful to keep your head down and focused on the task while you were in training?
Yeah, I thought about that question a lot before I put the microphone on, and the answer is I'm a glass half full kind of guy. I wouldn't have done anything different. I practiced for 25 years in one of the most beautiful and pleasant parts of the country, also somewhat impoverished, and I felt that was rewarding as well. And then I gradually segued from working 70, 80 hours a week in medicine and gradually decreased those hours and increased the hours that I did other things. So it was a very smooth, pleasant transition. And I didn't do anything unless it was fun. And so that's a very satisfying way to manage your career is to make having fun the way that it guides your career choices. Now, I'm a very lucky person because it turns out that all of the things that I enjoy doing make money to one extent or another. So it worked out pretty well. Not everybody's that lucky.
So, on that career topic for a second, let's just stay there. I found that a lot of doctors who are considering a second career, or maybe they're thinking about starting a side gig because that's currently all the rage in the physician space. There are Facebook groups that have 100,000 doctors just talking about physician side gigs. A lot of doctors feel a little stuck in medicine and they have that sentiment. So, do you think that doctors are stuck, or do we learn skills and training that could translate to these other fields? You made the transition from medicine to finance. Doctors may be considering that, or a wide variety of other fields. Do you feel like the skills that you learn in medicine translate and have helped you, or what is your view on that?
Well, sure they have. When you're a physician, you develop empathy, and that at least when you're dealing with clients is a very useful skill to have. Another skill that you develop when you do medicine is you develop an ability to write. At least back in the day when I was doing medicine, I did a lot of dictation, and I had to look at a lot of the stuff and edit a lot of the stuff that came out of my transcriptionist. Now that's a little different in the era of the EMR, and so that's a very useful thing. Surgeons I've found are very good writers because they tend to be very succinct. The more succinct you are, the better a writer you are. So that's a useful skill as well. The other useful skill that I developed was I was a dinosaur. I was a solo practitioner and basically ran my own practice. And I eventually got partners. But for 10 years, I was on my own, running my own business. And that is certainly a useful skill to acquire as well. But harder to get these days because most physicians these days are employees.
Yeah, no, I agree. I think it's interesting that the skills you learn are often discounted. You learn leadership, you learn the ability to communicate. If you're a surgeon, you learn how to write. I'm an anesthesiologist, so naturally I think about like what my predisposition is on the other side of the drape there. But I was also a philosophy major, so I'm probably not the most succinct writer that there is. But that's an interesting phenomenon that you're kind of pointing out with the surgeons.
Yeah. Philosophy, by the way, is an enormously useful undergraduate major. It teaches you critical thinking skills, and it's also a marker for other people because it's a very rigorous field. And if I'm an employer, I'm going to gravitate towards somebody with a good undergraduate degree in philosophy. That tells me that they've got the horsepower to do whatever cognitive tasks I'm going to assign them.
Yeah, I loved philosophy. I was a double major in chemistry and philosophy, and if I could go back in time, I would say I am a realist with pessimistic leanings. So maybe not as full of the glass as what you described earlier. I think that I would go back and just major in philosophy and take the pre-med classes that were required to take because I
Yeah,
loved philosophy so much. And I joked about it back then because if you get a philosophy degree by itself, oftentimes if you don't go into law or you don't go into teaching philosophy, it's can be challenging to use your degree. And so people will often say, like, you shouldn't go and get a philosophy major because it's just not going to be useful in the real world. And I would always tell people, I don't know if my philosophy degree is going to prepare me for the next step in my journey professionally, but what I can tell you is it makes me a better human, and which is fundamentally something I'm more concerned about than my professional career. And so I love that you are giving a lot of support to the philosophy majors out there. One thing I wanted to ask you is, I've heard, listened to a lot of different interviews, obviously read several of your books, which are phenomenal. But in one interview, you kind of mentioned that investing, which is a topic that I want to dive into with you now that we have you on the show. Of course, this is what I'm most excited to talk to you about. But investing is half math and half, I think you said Shakespeare, and that you shouldn't design your portfolio based on the 98% of the time that things go well, but you shouldn't design it based on the 2% of the time that it doesn't. And so, as someone who loves behavioral finance, I'd really love to hear what you mean when you say that we need to invest like Shakespeare.
There's what I call the prom queen theory of life, which is that if you're the prom queen, you tend to overemphasize the peak of your skill set, which is your physical appearance and charm. And find people in finance are exactly the same way, which is that the heart of finance is the mathematics. And there are people out there who can solve differential equations as easily as they can brush their teeth. And they tend to think that's the most important thing in finance. And it is important. But if you don't master the other part of finance, that is the liberal arts part of finance, which is what I mean by the Shakespeare, which is the
Mhm.
history and the neuropsychology, then you're going to have your head handed to you. And the boneyards of Wall Street are full of people who were brilliant mathematicians and thought they had discovered the fountain of youth, the mathematical fountain of youth of finance, and wound up blowing up very, very, very quickly. Why did they blow up? They blew up because they didn't pay attention to the history of finance, which is that once in a blue moon, your portfolio will blow up. And if you don't survive that, then you have violated Charlie Munger's rule of prime directive of finance, which is that yes, compounding is magic, but don't ever interrupt it. And the time when you're most likely to interrupt it is in that worst 2% of the world. So that's why the Shakespeare becomes important. It's not just that once every 10 or 20 years, things completely blow up and it looks like the world is ending and it looks like you're going to go bankrupt and you sell all your stocks. But it's also the psychology of that, which is there's a big difference between doing that exercise in a spreadsheet and actually living through it. And the analogy I like to use is that there's a big difference between crashing in a flight simulator and crashing an airplane in real life. You're going to respond very differently in real life than you will in the sim. And so that's what I mean by it's important to manage the map, but you also have to manage the history and your own neuropsychology. And if you don't do those two things, you're dead in the water. Now, what that 2% of the time means is that you have to design your portfolio, not with normal times in mind. You have to design your portfolio with that worst 2% of the world in mind so that you survive that worst 2% of the time and your portfolio survives and you survive and you benefit from the magic of compounding. And that means investing more conservatively than you think you should invest.
Yeah, I love that you talk about the market history piece there. And I actually was listening to an episode with you and going back in time, which I found fascinating because in reading the four pillars of investing, you bring up this example after the fact in retrospect of Kathy Wood and ARK. And the episode that I found that I was listening to was before the downfall, if you will, of that fund when Kathy Wood was in the heyday and was very much being having praise heaped upon her. And you gotta ask, like, "Hey, what do you think about this?" And basically pointed out, "Well, I don't know what's gonna happen, but I can tell you based on market history what I think will happen." And lo and behold, it ended up being exactly what you described. So, market history is fascinating to me, and I love that there was actually a real-time example in the 4 pillars of investing that you'd spoken on in the past. What do you think the lesson of Kathy Wood is for investors that are listening to the show?
Well, it's one of the smaller but important lessons of financial history, which is that in every era there is a star money manager or mutual fund manager that people that get a lot of publicity and their every word gets listened to, and invariably they plant their faces. Okay, and the reason why is because their outperformance, their initial outperformance, is due generally more to luck than the skill, and that's one of the basic things of financial practice that you learn by learning the history, which is that 95% of outperformance is due to luck. It's not due to skill. All right. And so someone gets very lucky and then eventually their luck runs out. But something even worse happens than that. It's not just their luck runs out, it's that when they outperform for 5 or 10 years, then people throw all sorts of assets at them. They wind up managing too much money. And that has an enormous cost. It's called performance drag or cash drag, which means that you are actually moving the market. So if you're managing $100 million, you're not going to move prices very much when you trade. But if you're managing $10 billion, then every time you buy, you're paying too much, and every time you sell, you are selling too low because you are moving market. And so that invariably happens to star money managers as well.
with that history that you know about with those managers, and Kathy Wood is just an example of one of them. You give several examples in your books. You also talk about other kinds of market history, and that market history is something we need to be knowledgeable about. There are entire books that have been written on the subject, but if you could distill some of market history into the most important take home points, what would they be outside of money managers and not following that trend? What are some other ones that we need to be aware of?
Well, it's that markets go through cycles of boom and bust. So during boom times, people are excited about the technology and they overinvest in certain areas. I mean, can you spell NVIDIA? Okay. And and then there are other times when stocks have done very poorly and have lost money, and no one wants to invest in stocks. The economy and stocks don't get cheap for a reason. They get cheap because people are very depressed about the economy. They're worried about the economy. If you were around in 2008 and you were investing in 2008, it really looked like the economy was going down the tubes and the world was ending. All right. And the message there is that the worst times to invest is when there's lots of blue sky and everybody's optimistic. Because at that point, prices have been up, bid up, and expected returns in the future because you're paying such a high price right out of the starting gate are going to be low. On the other hand, the best times to invest is when the clouds are the darkest and there's death, doom, and destruction in all four quadrants, as pilots like to say. And those are the best times to invest. The best times, to use another metaphor, are done in the stormiest waters because you're paying depressed low prices and you will probably have a high return going forward because the prices that you're paying are so low. Now, this gets something to something else, which is that if you are a young physician and you are just starting to save, you want to get down on your knees and pray for that death, doom, and destruction and bad security returns so you can accumulate all of your stock assets at low prices. And with luck, in your later decade, those will recover and you'll have a big pile of assets.
Yeah, I very much like buying stocks at a deep discount, and recently when the market had some turbulence to it, that is exactly what I encourage people to do. We actually had a show on that exact topic, which is something that it's all about framing and how you see things. And I'm kind of curious. You frame this in terms of clear skies, cloudy skies, choppy water, and when you read some of your writing, if you can, PDF, it's free on Efficient Frontier, which is amazing that you provide that for people. You kind of distilled things down to a pretty understandable 10 or 15 page PDF on investing and how to be successful. And yet you also run an advisory firm. So when people have these choppy waters, these dark skies, what are your thoughts on doctors investing themselves and having a do it yourself approach versus getting professional help from an advisor?
Well, the big mistake that physicians make when they invest is they don't treat investing as a serious subject. Make no mistake about it. Finance and investing is a serious endeavor, just as medicine is. So just as you would not endeavor to treat patients without, in your first year of medical school, learning the basics, anatomy, physiology, pathology, pharmacology, there are certain subjects that you have to master, you must master to do finance. And the problem that physicians have is they think to themselves, oh, this is easy. I'm just going to invest in this mutual fund or that, or I'll follow this strategy or that strategy. And that's kind of like deciding that you're going to do neurosurgery, having read USA Today for a couple of months. It just is not going to work. So you have to put the time in. So what is the anatomy, physiology, pharmacology, and pathology of investing? Well, it's four subjects. Theory of investing. You have to learn the theory of basic finance. You have to learn the history, which is what we've been talking about. You have to learn about not only your own neuropsychology, but also the psychology of crowds. You have to learn a little bit of social psychology as well. And finally, you have to learn about the landscape of the investing business. And that takes time. Each of those subjects is the equivalent of, let's say, one of the medical school courses I talked about. So take the time. It'll take you several months to a year to acquire that. And once you've acquired it, then maybe you can invest on your own. Now, even after you learn those things, you still have to have the emotional fortitude to do it. And not everybody has that. So if you can't do that, if you're not willing to make that effort, and if you're not willing, you may not have the temperament to be a good investor, which takes time to figure out as well, then maybe you do need an advisor. Now, the problem is is that 90% of advisors aren't really up to the task as well. It's not just that they're not up to the task, they also have this enormous population of unsophisticated clients, and they're very gun shy about making even the smallest mistakes. All right. So they tend to be overly conservative. They tend to run with the crowd, which has its own costs. So, how do you pick a good advisor? And the very first thing you should do is make sure that they'll sign a fiduciary pledge. Okay. Stockbrokers are not fiduciaries. Investment advisors, registered investment advisors, or I should say, registered investment advisory firms, which is what RIA refers to, are fiduciaries. And you can just download the fiduciary pledge from the internet. And if they're not willing to sign on to that, and it's fairly rigorous, then, or they give you excuses why they won't sign it, then make a 180-degree bat turn and run the other way. All right. That's the number one thing you do. And number two is you just very innocently show the potential advisor a portfolio consisting of index funds of US stocks, international stocks, and bond funds and bond assets. And if they tell you that that's a terrible investment, terrible strategy, and they can beat the market, again, make that 180-degree bat turn and run. Because if they really could beat the market, they wouldn't be managing your money. They'd be borrowing money, managing their own, and going to the beach. And so and if they, on the other hand, if they look at it and they say, that's okay, I'd tweak it this way or that way, maybe change the percents, changes a little bit, maybe have a value tilt here and there in passive fashion, sure, that's okay. But if they tell you they can do much better than that, that's the litmus test for somebody you want to avoid.
Yeah, I really enjoyed your discussion on tilts in the four pillars of investing. You talked about small and value tilts and the work that French and Fama did, and I think it is fascinating understanding the way that advisors work and what the incentives are for them. And if they're unwilling to sign a fiduciary agreement, they're very clearly stating that they don't have your first interest at heart. And I think that's hard for doctors to understand because we have a Hippocratic oath, right? You can't imagine a doctor going into medicine not wanting to do what is best for the patient. And in the financial industry, a Hippocratic oath doesn't exist unless you do have a fiduciary pledge.
Yeah. And despite the Hippocratic oath and the implicit fiduciary pledge you have as a physician, there are still surgeons who do unnecessary surgeries. There are still gastroenterologists who do unnecessary scopes for the money. And so if there is a small percentage of physicians who behave that way, a fortunately small percentage of physicians, and I can assure you there is a much larger percentage of financial people, probably greatly in excess of 50%, who are willing to break that pledge.
Yeah, yeah. So let's take this lesson on history a little bit different direction. One of the questions that I was most excited to ask you about in preparation for the show is you have consistently over the years predicted a real rate of return on investments to be below 4%. And so when we're looking at market history and you hear people talk about getting 10 or 12% with mutual funds, some big names out in the personal finance space that say things like that. I'm really curious to know from your perspective what your thoughts are on kind of predicting that 3 to 4% range. I know it's varied over the years what you've predicted, and then how it's compared to what's actually happened. I would love for you to explain your thoughts on future market returns.
Yeah. Well, okay. You have to ask yourself, where do stock returns come from? And when you look at them, they come from dividend distributions and they come from dividend or earnings growth. And the long-term expected return of stocks is simply the sum of those two terms. Now, that 3 or 4% return that we're talking about is a real return. So that's in addition to inflation. So that maybe translates out to 6 or 7% of nominal return. Now, the problem with that prediction is that it has an enormous error bars around it. So if I say that the expected returns in stocks are 7%, which is about what I think they are now, nominal, the error bars there run from minus 15 all the way up to plus 20 or 25. And so the longer the time horizon you have, the more likely you are to be accurate, that noise, those error bars wash out. So I've written several books in investing, and the shorter the time horizon or the newer the books are, the less accurate they tended to be. But the very first book I wrote was one that I wrote 25 years ago, and the expected returns predictions there are very accurate. So if you're going to do that, and realize that you may be very wrong for 10 or 15 years. Probably at 25 or 30 years, you will be right, but you're going to have to be patient.
Yeah, and I love that because there's such a practical application to that when you try to figure out how much do I need for retirement, and based on that number, how much do I need to be saving each year to get there, and of course that's going to be in a large part determined by what you actually get in terms of returns in the market. And so I love your take on it because it allows you to have a semblance of an idea of like what should I actually be putting into this calculator, and I do think that the real versus nominal difference is very important, right? People just think about what is the stock market going to return. They don't account for inflation, that real return that you're going to get, which I think is important that you highlighted.
The one thing that is very interesting about that calculation is that there is a vehicle now, which are Treasury inflation protected securities, that will give you a guaranteed real return at whatever time horizon you want out to 30 years. So if I decide, for example, that I'm going to be alive 20 years from now, and I want so much money, real spending power in 20 years, I will buy a 20-year TIPS, one that matures in the year 2044. And not only will I get my principal back adjusted for inflation, I will get my real spending power back, but I will get a 2% return along the way as well, which is also real.
Yeah, no, I think tips are a great thing to bring up there. And so that is a financial instrument that you can use. I'm not sure how familiar you are with the physician finance space when it comes to real estate, but over the last 4 or 5 years, a lot of the listeners on this show and on a lot of the other shows have really been kind of inundated with real estate propositions, which have been really interesting because they've typically come from other physicians in this space. And some of these are syndications, some of these are take my course so I can teach you how to buy a property and then start making cash flow from that so you can get to financial independence faster. It's something that people run into a lot. So I really want to know your thoughts on real estate because I know you're a huge fan of low cost diversified index fund investing. Is real estate something that every doctor should be doing, or is it something that's completely unnecessary that it isn't required? Like, what are your thoughts on real estate?
Oh, God, no. I mean, of course not. And the reason is basically what I was talking about investing in finance before is you would no sooner start buying and investing in real estate without any training or expertise as you would doing brain surgery without any experience or expertise. There is a lot of experience you have to have. There's a lot of theoretical knowledge you have to invest well in real estate. And if someone else is trying to sell you a real estate investment, should almost certainly not be buying it because if it were really that good of an investment, they would not be selling it to you. They would be keeping it for themselves. The bottom line is don't do it unless you're willing to do the homework first.
Yeah, I think people don't place enough emphasis on the fact that it is a second job and there is a lot of involvement. I think that they have this idea of grandeur that they're just gonna have passive income coming into their life from this amazing real estate portfolio they have without considering all of the active work that's typically involved.
Yeah. I mean, what I like to say about investing is it's not an investment, it's a job. And it's a job that you should definitely enjoy doing if you enjoy fixing toilets and dealing with drug-addled tenants who are perhaps heavily armed.
Yeah, I actually had a friend in medical school who had that exact situation happen where they moved from the home that they had. They stayed in the same area for their attending physician job and rented out their original house they had during training. And like 2 or 3 years into owning the home, their manager basically called them and said that somebody had been selling drugs out of their house. And when they got to the inside of it, the entire thing was spray painted and destroyed. And they have never since then owned another real estate property outside of their primary home.
Yeah, the joys of real estate. Yeah.
So as I've heard you speak over the years, I've heard you talk about cryptocurrency a couple of times, and I love just kind of checking in and seeing have your views changed? Is this something that you still feel the same way about that you did 3 or 4 years ago when Bitcoin was making all of its moves? What are your thoughts on cryptocurrency and NFTs? Kind of some of the more alternative investments that are out there.
Well, an investment is something that yields income and a reasonable promise of return of principal. And cryptocurrency doesn't do that. What you're depending on with cryptocurrency is being able to sell it to a greater fool. And so that problem with it, there's a semi-apocryphal story from Joseph P. Kennedy during the period leading up to the 1929 crash. He is said to have said that he knew to get out when the shoeshine boys were giving him tips. Well, today's shoeshine boy is the Uber driver who's telling you about their crypto investing. Okay, it's a good sign to get out.
I love it. When everybody knows something, it's no longer a secret, right?
Exactly.
So, Bill, as we close out this show, I'd love to know, is there anything else that we should have covered that I didn't ask you about? Is there anything else you would want a physician earlier in their career or in training to know about personal finance?
I would just reiterate what I said before is to please treat finance as a serious subject. Just don't jump in to the next hot mutual fund. Just don't buy the next stock. Your ex fraternity brother or sorority sister stockbroker tries to sell you one. Do the homework. All right. And the homework, I try not to plug my own books, but please do download if you can, which is for free. I won't make a penny off it. And follow the course study that I outlined in that.
And cannot reiterate enough how amazing If You Can is. I give it to every single fourth year med student that comes through Wake Forest. So that is doing amazing things where I am. I know it's doing amazing work for everyone else. And I will plug your books, and I'll put links in the show notes that you should absolutely go buy Bill's books. I've really enjoyed the Investor's Manifesto and the new iteration of the Four Pillars of Investing in particular. So if you're looking to learn more about investing, I can't recommend them highly enough. Bill, thank you so much for coming on Money Meets Medicine. Really appreciate the opportunity to chat with you.
My pleasure, sir. You take it easy.